Cool. So yeah, thanks for joining. um, this is yeah, we just wanted to run through sort of the three main use cases and how different funds are managing them on bound. So just the scale of the problem, obviously in the news quite a lot at the moment, currency volatility. Not too sure how often people actually like look at the charts and stuff like that, but yeah, some major swings are sort of near on 10%. Almost sort of every quarter over the last few quarters. So these are kind of the three main headaches: investments and capital calls, foreign exits, and management fees. We're seeing that management fees is kind of like an easy one, and not really kind of, well, obviously important, but exits by far the most important, but certainly the more frequent ones tend to be the investments and capital calls. So yeah, Will, do you want to talk through this one while I'll set up a demo account?
Yeah, absolutely. So I think yeah, as Luke's kind of pointed out, sort of investments is where we see most of the amount of sort of flow or activity. Obviously exits are kind of, we'll get onto exits, but obviously the quantum there is significantly larger, and the variables are significantly kind of more so. But I think where we're seeing most amount of challenges is kind of on the capital call side. So a lot of funds would, when they're making, let's say it's a dollar fund, when they're making an investment or writing a ticket that's outside of their base currency in euro, sterling, whatever it might be, invariably they're adding like a buffer, could be 2, 3, 5% to the ticket size that they're calling their LPs for. And what that creates is a sort of challenge where you're either overcalling or at worst undercalling from your LPs. But essentially in broad terms, like where the risk window starts is when you sign the term sheet, i.e. you're kind of having conversations with a potential portfolio company, or you're reinvesting, and the term sheet is signed. So that's when the clock starts ticking and your exposure starts as you're kind of making that investment. Now what we then see is normally kind of, that period can be anywhere between like a week to 4 weeks between term sheet signed and cash actually delivered to the portfolio company. In that time, sometimes kind of a week or so before the cash is actually delivered to the portfolio company, the fund will then make the capital call to the LP. So that's when they're actually kind of physically kind of crystallizing the amount that they're calling down. And what we sort of normally see is that actually people are just transacting at, or historically would have just been transacting at spot, meaning that they're fully exposed to the kind of vicissitudes and the market movements over that 1 to 4 week period between when the term sheet's signed, cash is called from the LPs, and cash is actually delivered to the portcos, and the market is doing what it does in that period. So there's a couple of ways of addressing these challenges of kind of ensuring that you're not overcalling or undercalling from your LPs, and B, ensuring that, like, if you are in the instances where you are overcalling, obviously there's the IRR clock is ticking kind of as soon as you draw that cash from the LPs. So actually you want everything to kind of net off exactly. So really simple kind of way of addressing this challenge is, as and when the term sheet is signed, is you put on a range. I'll pass over to Luke to kind of show you what that looks like. But in broad terms, ranging removes all of your downside risk, as you're fixing a price, or you're fixing a worst case scenario, selling dollar, buying euro, or whatever the example might be. The additional benefit of ranging is if the market moves in your favor over that period of time, that 1 to 4 week sort of risk window, ranging will allow you to capture that upside. So you're essentially putting in parameters to remove all downside risk, but also capture all of the upside over that period of time. Which, to Luke's point, I think we've got a chart that we should probably show you of kind of where sterling dollar and euro dollar have been over the last sort of 12, 24 months. But certainly over a kind of 1 to 4 week period, you could easily see swings of anywhere between kind of 1% and 3%. So, on ticket sizes of kind of 1, 2, 5, 10 million quid, that exposure is relatively significant. So ranging removes the downside risk that you can get sort of hit by that 1, 2, 3% swing, but it also gives you all of the upside. So if the market does move in your favor by 1, 2, 3%, that's all in your pocket, and that's all kind of gains that you guys are kind of making there. Luke, I'll just pass over to you just to kind of run through the specifics here.
Yeah, exactly. So what we're seeing is as a term sheet signed, what we're seeing then is people come in and put their ranges in. So let's say it's a dollar fund and written a ticket in euros for, I don't know, say 2.5 million euros. All they need to do is come in here, just pop the euro amount in, set the protection. Most people set it anywhere between sort of 1.5 to 2 cent off, but really this is sort of how much risk you guys are willing to take on this. But at the moment we're literally just putting barriers in to just protect against like worst case scenario. So you have like a defined cash flow range here. You can expect settlement somewhere within the next few weeks. We could say August the 5th. All of these are fully flexible inputs. If you want your worst case scenario to only get better, if the market moves in your favor, then you can just toggle on trailing stops. And what that means is the exact percentage threshold here will always be maintained. So if the market starts moving down, your stop will automatically drag down with it. And that happens 24 hours a day. So you could be in bed and that's happening. So what we're seeing is people initially set their protection up here at term sheet signed. And then when it comes to capital call, like Will says, you don't want to under or over call. You want to keep good hygiene and ensure a healthy IRR. So at that point, let's say a few days passes or a week passes and now is the capital call. They can come here to fill now. And what that will do is whatever the prevailing rate is at that particular moment in time, it's just going to lock it in for the future settlement date. And if the future settlement date needs to be moved even after you've done that, so say we're now in this state and somebody's not sent their money in on time, you need to just move it out for an extra day or an extra couple of days, you can just come in here and move that out. But essentially what this does is helps ensure that you have good hygiene really, and you don't have sort of money sitting in the fund that's just not really doing anything. It's not really good for you guys or for the LPs. Any sort of questions on this approach? No? Cool. Right.
Just to add on this, this is something that Market Connect Ventures uses. Notion uses this approach. Quite a few of the VCs that we work with would use this approach because essentially the goal is like eliminate that risk window of like 1 to 4 weeks or however long between term sheet signing and cash is delivered. And how do I remove FX volatility over that period? And this does it kind of incredibly effectively by giving you kind of parameters in which you're guaranteed to trade. So you've always got a worst case scenario. So you know that X amount of euros is going to equal Y amount of USD. And then when it comes to the capital call, you crystallize that amount. So you're always going to be calling for the exact amount. So you'll never need to add a buffer. Obviously, there's kind of additional costs that we're probably not aware of, where, lawyers' fees and various kind of transactional related costs that might be built in to what you're calling, kind of in addition to the actual amount that you're investing. But yeah, that's above our pay grade. So we'll leave that question to you guys. But yeah, it's kind of one of the major kind of benefits of this is you're never going to be overcalling, you're never going to be undercalling, you're always going to be calling for the right amount. So it removes that kind of need to put in a buffer.
Cool. And then moving on to exits. Obviously the goal is to protect and maximize returns. we saw the chart at the beginning that showed how volatile markets have been, and obviously losing 10+% over a few months.
You did actually. Can you show us that?
This one.
There we go.
Yeah. So yeah, even in relatively short periods of time, I mean, exits obviously take much longer through the negotiations, but yeah, if you were beginning exit conversation sort of down here and then finishing up here and it's a dollar exit, you've lost, what's that, like nearly 20% of your deal, which obviously you hope to 100 exit or 200 exit or whatever, but yeah, losing 10+% right at the end just due to FX swings could turn something from an absolute record breaker to just like a great deal. Obviously the amounts and the timings and everything are highly unpredictable. So what we're really saying here is if it's kind of like a minor exit, kind of sub 4 or 5 million, something around that sort of size, then ranging is perfectly suitable for that. Any sort of major exits of really big numbers, definitely talk to us, as there's some things that we can offer off platform that might be a little bit more suitable for such bespoke things. And then finally,
minimus there in terms of talking about that. What's your sort of range of value for talking about those?
Say it again, sorry, Steph.
What's the sort of valuation in an exit that you'd look at in terms of that off platform?
Well, I think whatever to be honest, there is no specific number, right?
Okay.
Like, I think Luke and I are both like FX brokers. Well, the good stuff, not the bad stuff, like at heart. So like we both, been in this sort of business for like well over a decade each. So we're more than happy to talk markets at any juncture. In fact, we relish the opportunity to. But I think it's really up to you. I think ranging is a really good product in that it removes downside, gives you the upside. It's a really, really simple kind of user-friendly product. I think where exits are challenging is due to their nature and their variability, right? The amount can change, the deal structure can change, the timings definitely will change over a period of time, and that could be at the 11th hour. So I think if it's entirely up to your kind of comfort level, right? If you feel like actually it's a relatively small exit and we think ranging would serve the purpose, whack it in. You can do it yourself. If you want to have a conversation, then what we tend to find is that actually people would use like a blend of strategies, and probably do like a percentage of different types of structures. So ranging might form a part of that, averaging might form a part of that, potentially even like derivatives or option structures might form a part of that. I think options and derivatives can be quite a scary word to a lot of people, but the reality is they serve as an insurance product. That's essentially what a call option or a put option is. It's an insurance product that comes with varying degrees of premium, which can be mitigated by going out of the money or depending upon what side you are, it kind of dictates how far out of the money you might have to go. But I think that the point here is that there's no kind of one size fits all for exits, because each kind of exit is different, yeah, we're more than happy to kind of show you what other people are doing and what we see as potential. And also, obviously, there's market factors as well of like what the market's doing currently and where it could go. If you're looking at kind of more volatile pairs or less volatile pairs, that would again kind of inform the strategy that you might choose. So it's really kind of variable depending upon kind of what you want to do. Does that answer your question?
Yes, sorry, it does. Thank you.
Cool. Any other kind of thoughts, questions on sort of exit from any of you guys? I mean, anybody had any challenges with them or war stories they want to share?
I guess it's always just, uncertainty on timelines. Will it happen? Won't it happen? Even up to, a week before at times. So, yeah, I guess that's the nature of the beast.
for sure. And I think that always forms part of the conversation of like, actually, can we build something that's like a deal contingent hedge here? And like, what if things do fall out of bed at the last minute? How much am I going to be on the hook for? And that conversation always comes up of like, actually, do I really want to hedge the full exposure of the expected amount that I expect to be coming in? And the answer to which is probably no. Like you may want to build incrementally your protection levels over a period of time, and as certainty kind of ramps up. I think saying talk to us is probably not that helpful, broadly speaking. But it really is so variable depending upon your confidence levels of the deal. And again, that would inform kind of what we sort of might what we might kind of show you, and will inform the kind of considerations and solutions that we present.
Yeah, very fair.
Cool. And then finally is just management fees, which are obviously very, very predictable. They're known normally on a schedule. And what we really see for this is that people just don't want to spend time thinking about this. They certainly don't want to get called up by an FX broker when rates are really unfavorable and get pressure sold into locking something in now. When rates look bad, and obviously they could get worse, but really I think that this is very similar to how a lot of our VC portcos that we have as customers, it's a similar sort of exposure, and really it's more just kind of about diversifying the risk, rather than sort of concentrating it all on like one day or 4 times a year when you need to convert, when your management fees come in quarterly. You wouldn't put all of your 100% of your fund into one company or 4 companies. Obviously you'd spread the risk around, which is exactly what averaging does. So it's pretty simple just to turn on and forget about. The results that it actually gives, we built this little simulator just to show an animation of what it actually does. So red jaggedy line is obviously the spot market. Purple line is the smoothed out average line. So obviously nobody knows where rates are going to go, and unlike deals where there's like a defined risk window of 1 week to 4 weeks, or for exits obviously slightly longer, but there's going to be an end date in sight. For management fees, obviously this is like a long-term thing of years, 2 years, 3 years or more. And who's going to be able to call when's the best or worst time to lock the rate in over that period of time? Absolutely no one. Obviously in shorter time frames it's a little bit easier to look at markets and play around with different levels, but over a 2 or 3 year period, absolutely impossible to say where sterling dollar or euro dollar or anywhere is going to be, particularly with Donald Trump in the White House. So setting up an average is so easy on Bound. All they need to do is just come in here, hit averaging, and just say, right, we get our management fees in dollars. We want to settle whenever 2nd of September. It's going to be $1 million, or whatever the amount is. Hit review, hit confirm, and that's done. That'll just begin to average now until the settlement date. The way it works in the background, just for clarity, it's super simple. All it does is just splits up the $1 million and just books these mini forward contracts every single day automatically. That's how you obviously achieve the average. So doing this manually, or not with Bound, would be incredibly arduous to manage all of these positions all the time. But yeah, just kind of leave it at that. And then what we're seeing is that companies would have 4 of these out for the year. So you can set one up for September, another one out for December or whenever, and just literally just manage the schedule like this. Don't put too much thought or attention into this. Just literally accept that by diversifying your risk with averaging, it is strictly smarter than picking 4 arbitrary days a year to convert spot at, and just kind of let it go and forget about it. That's what we're seeing there. But
yeah, I think it's the kind of I think that's the sort of most salient point here, that is that trading spot is incredibly risky. And yes, it can pay off, right? Like no one's denying, you know, playing roulette can pay off. But logically, averaging over an extended period of time, by that I mean anywhere kind of typically beyond 3 months, will compress your exposure to volatility in all cases by 90% or more across all G10 currencies. And I suppose that one of the sort of challenges that we as a business face is trying to get people away from trading spot. And this is one of what I mean, as a business, we offer spot basically next to nothing. And the reason being is it does absolutely nothing to mitigate risk. You know, and we're very much of the belief that trading spot is a sort of a bad habit. It can be a necessary evil, you know, if a bill needs paying or you know, something out of the blue kind of lands. But strictly speaking, it does nothing to manage your risk. And a spot trade, it's kind of whether it's a good trade in inverted commas can only be defined like by looking back in the future. Whereas averaging will always trend with the market. So it really is one of those things that we kind of, with averaging, you can just set it and forget it. So put in your expected cash flows in the knowledge that actually if things change, you can amend the amount, amend the dates at any juncture. And also you kind of, we see, I suppose, slight kind of segue, but we see this is really, really applicable, averaging, particularly for early stage kind of portfolio companies as well, who are trading spot and essentially taking chances on the market. And you know, one of the kind of comments that we get is that we don't have kind of we don't have the capacity to look at this, we don't have the capacity to address it, it's not a big enough problem. But I think the reality is when markets are moving, sterling dollars moved 13% this year to date. So the 13%, you know, particularly on operating costs, where there's no gross margin involved, people care less, understandably, but on revenues, that's a significant impact to anybody. You know, we do a lot of work in the sort of fashion and apparel sort of space, and where gross margins are really thin, and taking a sort of 13% hit to anybody's bottom line is really, really significant. So I think, you know, as a kind of principle of hygiene, generally speaking, trading spot is incredibly risky by its very nature, whereas averaging compresses that risk and reduces it kind of massively. Any thoughts on this or any kind of questions from anyone? Cool.
Would you see anyone use this sort of style, for which, you know, the example here for management fee, for bringing across a realization from an exit? And I know we've already talked about the exit in a different section, but that sort of piece of, you know, if and Andrew, you know, I think mentioned, you know, you just have the inherent uncertainty with an exit. Just because you've signed the term sheet doesn't mean that it goes ahead. It doesn't mean it goes ahead by a certain date. Do you just wait till you get the euros in, and then once you've got the euros in, you then have a plan after that on if you do averaging, if you do something else?
So averaging by its very nature is a cumulative strategy, right? You're setting a specific time frame, and you're building your position over the course of time to give you the 100% at the end of that time period. So we often see with exits that people might set up a range of like risk tolerances, essentially, of going like, I want to return X on this investment. So, you know, in the sake of, you know, let's look at sterling dollar. Let's say what my worst case scenario, I'm happy to accept a rate of 130, right? But what we often see is people set up these ranges, but then they average in that period as well. So, so you can be building a position, you can be reducing your exposure within a predefined range as well. So absolutely, it forms part of like a kind of an overall sort of risk management approach. So you're setting up the ranges, and you're going, right, I'm unwilling to take any risk below this point, and you, because they're just orders, nothing's actually happening when you're setting up a range. You're just going, if the market goes below here, protect me. If the market goes up here, I'm over the moon, trigger. But in that time frame, we often see that people are building up averages. So yeah, absolutely, this can form part of sort of exit planning as well. And obviously, as I say, because it's a cumulative strategy, you're chipping away at the overall exposure. So yes, you are taking some risk if the deal does fall through, but it's cumulative and it's spread over a period of time.